And so in today's session, we're going to talk about stocks and how to invest in stocks. And I'm going to share some of the very preliminary insights as to what it entails, what you must know, what you must be aware of as an investor, and how to start the process. In many ways, for most people, the word stocks rings as something that you maybe watch on the TV or the television, and you see graphs of things spiking in price and volume. And so we generally perceive stocks to be like this ticker symbol that you see on maybe Bloomberg or whatever your local business news station is. And so we think it's something that changes very quickly. It flickers and it changes and it goes up and then it goes down. And for some reason, some of us have an emotional view of what it means. Some of us think it's really gambling. Some people are playing around with the markets. A stock is not a ticker symbol that goes up in price and goes down in price, or goes up in volume and comes down in volume. The best way to understand stocks is to understand business. As a matter of fact, one of the investment vehicles that you might want to consider is investing in a business. And there are two ways you can do this. You can invest in a private business, or you can invest in a public business. A private business is a business that is owned by a number of individuals or a single individual, where they have mutual agreement on the mission of the company, the purpose of the company, the vision, and more than anything, the strategy in how the business will be conducted. And they have this, what I call a sphere of influence and an agreement. They have shareholders, and those shareholders could be the original partners or original people who set up the organization, the founders. You can also have other people join the company, but it's still private. It means your affairs and how the business conducts its operations are in many ways close to the public. You don't have to disclose anything publicly. It's a private business. And there are so many ways you can set that up. You can set it up as a limited company. You can set it up as a partnership, depending on the jurisdiction you find yourself in. Here in the UK, we have limited liability companies. And the structure of the company in many ways determines the responsibilities of those who are responsible for managing and leading the business. But let's not go into that. In principle, that is what a private business is. So you, as an investor, can decide that you're going to invest in a private business where you understand what the business does, you understand the management, and therefore you can make a decision as to whether you believe in 10, 15 years, it'll be where you hope and expect it to be. On the other side of the equation is a public business. And a public company is simply a private company that has decided to open its doors to the wider audience for some reasons. It could be because they need liquidity, they need more cash, they want to attract more attractive shareholders, maybe they want to attract better management, so they make it public. And by making it public, they sell shares of the company. I'll give you a good example of what that means. If you had a private business, if it had more than one owner, you would have a distribution of the shareholders. So you might have a company that has 100 shares, it's a private business. You might have those 100 shares distributed amongst the people who own it. If there are 10 owners, then in principle, you have each person having 10 shares. So each person controls or maybe owns 10% of the company. If they decide to go public, they might decide that they're going to retain the same management structure as it currently stands, but because they're going to go public, they open up the doors and they say, well, we're going to sell 50% of the shares of the value of the company. And for that 50%, we're going to create 1,000 shares. We're going to sell 1,000 shares to the public. We will still keep the 50% amongst the original founding members. And therefore, because they've opened up the doors to the public, they have to accept that they've diluted their control. And therefore, the people who buy the shares from the public are now partly shareholders. You might have a managing owner or managing shareholder, and you might have just an investor shareholder. But in many cases, what you now have is an agreement, an arrangement where the public owns part of a company. So shares are simply ownership structures of businesses. A share is a part of a company. So don't look at shares as this thing that goes up and down in value. Look at it as a part of the business. You buy one share of the business, it means you have a fraction of the total business. Now, a public company, before you go through that process, you have to go through what we call an IPO, which is where you go for an initial public offering, where you put the shares out publicly and raise funds. So before the company goes public, you have what we call internal, the internal market, which is between the people who run the business. They can sell shares to anyone privately. Once they go public, you have what we call an external market. So what you see on Bloomberg, or what you see on Sky News, or what you see on the business networks, is what we call the secondary market. The primary market, or the internal market, is what happens within the company itself. The external market is what happens within the secondary market. So it's external. This is important. So in principle, buying a part of a company or buying a share in a company means that you have ownership rights. You also have rights to the profits that the company generates. But in addition to that, you also have responsibilities in relation to losses that the company could incur because you're an owner. If the company is structured in such a way that the company will pay what we call dividends, which is if the company makes a profit, it distributes some of the profits to all of the shareholders as interest. So if the company pays dividends, then you also have rights to the dividends that the company creates. So in principle, you as the owner are entitled to two important income generating streams. Number one, profits earned through dividends, through income. Number two, profits created as a result of capital gains, which is appreciation. So for example, if you bought a share of the company for £10 and 2 years later on, it's £20. It means that the value of the business has grown. So you're entitled to the profits it creates every month or every quarter or annually. But in addition to that, you are entitled to the appreciation over time. So as a shareholder, you must know your rights. That's the first thing. You must know your rights. Now, once you go public, the company must have what we call a board of directors. Now, these are people that should be selected independently to represent you as the minority shareholder, because you're passive invested in. They represent your interest, and they have this responsibility of making sure that the company itself and the people running the business are making decisions that are tailored to your expectations, that they're not making, irrational decisions that go against the shareholders' expectations. That's how a company operates. Now, why have I spent some time explaining this? Fundamentally, if you don't understand how a business functions and you're trying to invest in stocks, then you've put yourself in a category that I call the losers category. And the reason is because you're operating with less information, you don't know the rules of the game, and therefore you're bound to lose. Because in every public company, and there are exceptions, but in every public company, what you generally have is people operating the business, but some of them are not the founding members. So they're really there for themselves. They want to make as much money as they can. So they're going to try and extract as much as they can from business. You, as the partner, as the shareholder, needs to know your rights to ensure that the board of directors you have, keep them in check so that the company's value increases and the profit it creates every month or every year increases. That's the most important thing you must understand as your responsibility. Interestingly, many people make the mistake of thinking that the CEO of a public company is in control. You, as the minority shareholder, you are in control. If you can get a number of shareholders together, you can vote through the board of directors you've elected to replace the operating executive or the CEO. So you've got to understand your rights, and most people don't understand this. Now let me move forward from where I started. I said, if you're going to invest in stocks, you have to know how a business functions. You have to know the dynamics of a business. But you can invest in a company when it's private, or you can invest in a company when it's public. What some people try to do, some do it well, some don't, is they invest in companies when they are private and they wait until the company goes public. I'll give you a good example. Uber was a private company. Then it moved down to the stage of going public. Facebook was a private company. Then it moved to public. You can go through Microsoft, Amazon, Apple. All of these started as private companies. And then they moved into the public scene. Why? Because they wanted to generate more capital. They wanted to grow in scale. They needed liquidity. So in many cases, if you invest in a company during the private stage, if it's a great company, if it has good prospects, if over time it continues to increase its sustaining and competitive advantage and continues to produce great products and is profitable, it would mean that when it goes to the public market, you have a lot of investors who are dying to invest in the business, and therefore you can make a huge amount of return once it goes public. On the other hand, if you weren't lucky enough to go into the private section of investing, you can wait until it's public. When it's public, it means it's available in an external secondary market, so you can buy and you can sell. When it's private, it's in an internal closed market. You can't buy and sell. You have to be invited in by the people who run the business. Once public, you have the ability now to buy as many shares as you want. So buying stocks or investing in stocks requires a number of very important, what I call preliminary requirements that you must go through. I call this a checklist. Every time a pilot wants to fly from one location to the other, they go through a checklist process. Why? Because they cannot trust such a huge responsibility to their experience alone. So they do a pre-flight checklist. They look through all the things that they must check before they set off. But interestingly, when they arrive at the destination, they look through the same checklist before they disembark. So you need a checklist. And I'm going to share some of it here with you. Perhaps in the following sessions, I'll go into more detail. But you have to have a checklist of asking yourself specific questions to ensure that you're making the right decisions. I said something previously in the earlier sessions that whenever you have two people transacting, someone buying and someone selling, one person always ends on the loser's side, usually. Because one person is buying believing the value is going to go up, and another is selling believing the value could go down. One of you is always right. You want to be on the winning side. And therefore, to be on the winning side, you have to understand how the secondary markets function. That's the first thing. To understand how the internal primary market, which is the company itself, functions. Both are not together, none are the same. Let me stop here and explain what I mean. Whenever you look on the financial news and you hear information such as Apple stock is selling for $250, that is the secondary market. That has nothing, in principle, intrinsically, to do with how the company is performing. Within the company, we call that the company's books. So you have to go back as an investor and look at the company's books and see how it's performing. The market price and the company's value are not always the same. Never mistake price and value. Price in the secondary market is dictated by the behavior of the participants within the marketplace. If there's optimism about the company, prices will go up. If there's pessimism, prices will come down. Internally, which is the book, the value of the company depends on how much it's producing, how much it's creating in terms of growth, that you can analyze and assess using qualitative and quantitative measures, which begin in what we call the financial statement. But if you're in the secondary market, it's just a case of saying, what is the price? Are there people willing to pay more? So it's a case of buying and selling. So you have to understand the difference. Investing in stocks, therefore, requires you, as the investor, to make a decision. And that decision comes down to this. Am I good enough as an investor to be able to analyze the vicissitudes of the public market, the secondary market, to understand the psychology of the public market? And am I good enough, more importantly, to understand how the business is performing, analyze its books, analyze the results, and decide whether this company is doing well? That requires a lot of skill. If you can't do both, and you can't do it intelligently, then you cannot be what we call an active investor. You must go down the path of being passive. Now, that has nothing to do with you not being a good person or having a good IQ, but it's just a skill set that is very, very difficult to learn. Forgive me, let me rephrase that. It's not difficult to learn. It requires a lot of patience and discipline and temperament. It's difficult to execute on a long-term basis. And the reason is simply because in the marketplace, which is the public market, there's a lot of emotion. In the internal market, you need a lot of patience. And not everyone can subdue the emotion and hold on to patience, rationality, and discipline. And that's why it's quite difficult for most people to be good active investors. If you can't do that, then you have to go down the path of passive investing. And passive investing is whereby you say, listen, I don't have the skill set and I don't have the time to analyze these companies, because these companies create what we call performance indicators every year, every 6 months, every 3 months. But the company and the CEOs and the people operating it can make decisions that are not favorable. And if they make bad decisions, that could affect the value of the business. So being an active investor means you have to be regularly reviewing their performance, almost on a quarterly or semi-annually basis or annually basis. And that requires active monitoring. If you can't do all of that, then you can make a decision that says, I'm going to be a passive investor. So I'm going to buy what we call an index fund, which is I'm going to go to the market and say, I'm going to invest a portion of my money, and I'm going to go for maybe the top 500 companies, or you can go for the bottom 500 companies, but effectively you're not trying to pick who is going to be the winner. That is one option. Index investing. The second path is where you say, I'm not good enough to do this, and I don't want to go down the index path. So I'm going to find someone who is a good active manager who will be responsible for making this investment on my behalf. I would appoint them, I'll pay them a certain fee, and I'll ask them to manage my investment for me. And they will do this actively because they have the skill set to do the analysis. That is the second path. And doing that means you have a number of choices. You can go down the path of what's called a mutual fund. You can go down the path of what's called a hedge fund. You can go down, if you want, private equity. There's so many options. Unit trusts. I'm going to cover all of these in the future sessions, but effectively what you're doing is you're appointing someone to manage your investment for you. To do that well, you still have to have some understanding about businesses. So you can know which manager to pick. You have to look at their performance over time, and then before you give them your money. So let me bring this to a conclusion in today's session. Investing in stocks requires an understanding of how businesses function. It requires an understanding of the separation between an internal market, a primary market, and an external market, a secondary market. More than anything, it requires an understanding about how the public market functions, but also how the business internally should function. and knowing how to separate both. So if you want to become an investor in stocks, you have to start by trying to understand how a business functions. In the next sessions, we're going to still be on this same topic, stock investing, and I'm going to go into more detail. Stock investing is very synonymous with the word equity investing. So when you hear equity securities or equity investing, that's the same as buying stocks. If you buy the whole business, you're buying a business. If you're buying a fraction of the business, you're buying a stock, or you're buying an equity in the business. But remember this, stocks are fractional parts of businesses.